Welcome to another episode of Uncommon Wealth. I'm Jmac. Today we're joined by someone who's built a national reputation helping real estate investors legally reduce taxes, keep more of what they earn, and accelerate wealth creation through strategic planning. Our guest is Ryan Bakke. Pronounce it right?
Bakke. It's okay.
Ryan,
I've been called a lot worse.
Ryan Bakke. My apologies, brother.
Okay.
Ryan is the founder of Tax Strategy 365, works with hundreds of investors around the country, owns multiple CPA firms himself, and actively invests in real estate as well, and has become one of the most recognized voices in tax strategy for short-term rental investors. And in fact, got referred to Ryan through Bill Faith, who was also on the podcast not too long ago. Ryan's built a significant following through his own podcast, educational content, and tax planning expertise. Ryan Bakke, welcome to Uncommon Wealth.
I'm super excited to be here.
Yeah, man. Ryan, most CPAs spend their careers filing tax returns. You built a brand around tax strategy, which is unique in CPA world. Take us back to the beginning. What was the moment where you realized taxes weren't just compliance, but they were one of the biggest wealth building tools available?
I think for me, it all started when I was working at my first accounting firm. When I was 18 years old, still in college, I was preparing two tax returns one day, and there was a married couple making $200,000 in W-2 income, and I was preparing a tax return for a guy who owned a bunch of apartment buildings in Chicago, and he netted $400,000 off these apartment buildings, yet he paid less in taxes than the married couple, and he was single, which meant he was in a higher tax bracket. And I remember going to my boss and I was like, hey, did I do this wrong? Something doesn't seem right here. Like, he made double the amount of money that they did and he's single, yet he's paying less in taxes. And my boss is like, no, it's because he invests in real estate. And I pretty much spent the last 10 plus years of my life figuring out exactly how real estate investors and business owners can use the tax code to pay less in taxes than that of somebody who earns their money through work.
Like a W-2.
Yeah.
When did you realize that maybe the game isn't rigged against people, but maybe most people just simply don't know the rules?
I think it all goes down to, the Congress writes the tax code and the IRS just enforces it. Well, what is Congress made up of? Business owners, people who own property, people who own investments. So it's no wonder why they write the tax code that favors those types of ideals, right? And also, when you look at real estate, think about how many people get blessed on one single real estate transaction. You have obviously the investor, right? You have the title company, the loan originator, the realtor, the closing table, lawyer, accountant, contractors that are going to come work on the properties, cleaners that are going to go into the Airbnbs, guests that are going to stay, tenants that are going to live there. And a single transaction, the economic benefit of it benefits so many people. And that's why I do believe that it still to this day is the most tax advantage part of the tax code is to be a real estate investor.
And one thing I've noticed working with entrepreneurs, business owners, founders, is that many people focus on income instead of wealth. In your opinion, what are the biggest financial mistakes high income earners make?
Yeah, I think up until, like your number one goal should be, hey, if I don't do any tax planning, I'm going to be in a 37% tax bracket, which if you're single, I think you hit it right around $400,000 of income. And if you're married, it's closer to 600,000. Like your number one goal should be to make as much money as possible. I always tell people you'll come out ahead by making more money and paying taxes on it than if you didn't make the money at all. But when we get into those bigger tax brackets, 37% federal, then you have, if you're in a high income state like California or New York, you could be looking at 50% tax on every single dollar that you make. That's where tax planning becomes super important. I mean, we've definitely helped people tax plan at lower brackets, but for those entrepreneurs that are in those high tax brackets, it's of the essence. I mean, imagine like half of the dollar that you're making goes straight to the government. You're not going to be able to build wealth quick enough when half of your money goes to the government. I remember when we were kids, dad had the dad tax for Halloween candy. He would take out, 4 or 5 pieces. Imagine if he took half your bag, right? Like, like who wants that?
It's a de-incentivizer, right? Isn't there a famous, was it Ronald Reagan when he was an actor or something like that in California said, I forget the quote, man, but there's some quote out there when taxes were well above 50% at one point in time. Weren't they closer to like 75% when it was all in federal and state? And he said, why do I want to go to work? Or I forget, man. I should know that quote. Do you know the one I'm talking about?
No, I don't know the quote, but I mean, he was the forefront of Reaganomics, right? Which was the concept of, hey, if we keep more money in the pockets of the people that have the money and are the business owners, the investors, that it's going to benefit a lot of people. And I know a lot of people have their sides of the story, but we definitely live in a time today, especially with AI and automation, where, man, that wealth gap is just going to keep
widening.
People. It's the haves and the have-nots. I mean, if Elon Musk just became the first trillionaire. If you look at the 4 billionaires that are below him, his total net worth is more than all theirs combined.
I saw that,
which is crazy to think, and
that includes Jeff Bezos in that group.
Yeah, Bezos. I think Michael Rubin, Larry. What's the guy's name? Owns Oracle. I think Larry.
Larry Ellison.
Yeah, he owns Oracle, right? I believe. Yeah.
I think so. Yeah.
Yeah, like it's crazy to think, and that's just the world that we live in nowadays. I mean, you can like it, or you can try to learn and understand how to be better. And I wish Elon Musk writes a book after all this is said and done for us to read it.
I hear this all the time, and I know I'm talking with the CPA, so my apologies in advance, but they say my CPA handles everything. And a CPA often is the most trusted advisor in someone's trusted advisor relationships, ahead of their financial advisor, ahead of their life insurance guy, ahead of their attorney even. But often what they really mean is their CPA files their taxes. What's the difference between tax prep and tax strategy?
It's really looking at it almost, I use 2 different examples. So a tax prep person is like going to your dentist once a year and they stick that pick in your teeth and you're like, shit, and it's like, oh, you got a cavity. Like, now we need to, sell you something so your teeth stop hurting, right? That's like a tax file person. It's like, here's your numbers at the end of the year. Here's how much you owe. One of the things my boss told me, the same boss, he goes, poor people and middle-class people, they find out how much money they're going to owe or get back on April 15th. He said, rich and wealthy people, they know exactly how much money they're going to owe or get back before the previous year's even over. So they go into the holidays, they go into Thanksgiving knowing exactly what their estimated tax bill is looking like for the year, whether they owe money or whether they're going to get a refund. And that's a knowledge gap between the rich and wealthy and then the middle income class people, right? Versus a tax strategist, that would be like going to your dentist twice a year to get your cleanings, making sure that you're brushing your teeth every day, flossing. Like, that's tax planning in a nutshell, compared to tax filing, where, like I said, if you're one of those high income earners, even if you're just straight up W-2 and you may not think that you have a lot of write-offs at your disposal, having a tax planner can help you strategize around, well, I'm a tech W-2. Half my compensation comes from stock. When they give me that stock, they're withholding 22% tax. I'm in a 37% tax bracket. I need to know that difference so I don't have to write a $40,000 or $50,000 check come April 15th.
And whose responsibility is it to have that tax planning meeting? Is it the business owner, founder, entrepreneur who knows they're having a good year and they proactively reach out to their CPA? Or is it the CPA's job to proactively reach out to their clients, say, hey, I need to get you on the calendar for this time because we need to talk about strategic tax planning?
It's mutual, and I believe it's mutual, but it goes back to what you're saying of understanding, well, what exactly is your CPA doing for you? Because we have different types of engagements for different types of people. It's just like my grandma used to say. She said, some horses race better on different courses. You know, horses for courses, she had this saying. And so you have to know, like, hey, if you had a steady year, nothing's really changed a lot, you probably don't need a tax planning meeting. You know, you've been paying in your through your withholding on your W-2 or making your quarterly payments based on last year, you may not need a tax planning meeting. But if you had what I call like a shock and income event, where income's super high or super low, that's when it warrants like reaching out to a CPA or a tax planner to figure out, number one, what can we do? Like, what are the 9 to 13 strategies that we can implement? But also, what's the damage? Like, what am I looking at first? Because if you aim at nothing, you'll hit it every time. You know, I just had a client sell a property for $10 million, and they owned it since the 80s, so it's fully depreciated down to zero, meaning they have a $10 million gain. And, you know, I always started off with saying, here's what you're going to owe if all you do is put that check into your savings account. Here's the amount you're going to owe, $3.4 million, right? And then I go, well, you probably don't want to do that, because number one, now you're left with 6.6. But also, if you leave it in the bank account, you and I know that inflation is going to erode that dollar. So a year from now, that 6.6 really becomes like, you know, the government tells us inflation's 4% right now. If you look at the price of oil, gas, milk, eggs, it's probably running like 9 to 10 if you ask me. So that 6.6 a year from now, without any reinvestment or strategy, becomes $6 million worth of purchasing power. But then they go, well, how do I offset $10 million in capital gains? A lot of times it requires to invest a substantial amount of that money, right? So you're getting that $10 million check. For that particular client, they were going to have to redeploy $6 to $7 million cash to be able to save liquidity, to pay $0. Then it becomes a liquidity issue where there's always this push and pull between, you know, saving the most amount of money on taxes and then doing kind of what's the most financial best move for your life. Because I'm like, if your number one goal, if you're like, Ryan, I'll pay you as much money as possible, whatever your fee is, $5,000, $10,000, $15,000 for a call to help me to pay nothing in taxes, I can make that happen. Is it the best financial move for you? Probably not. Like, we should just bite the bullet on 3 of that. Pay the tax on that, put it in the index funds, and just sit on it. You know, another 4 to 5 million we can take and we can go and reinvest that, sure. But that's kind of the balance, like the push and pull, and that's why it's helpful to have, you know, not to toot my own horn, but that's why it's helpful to have a CPA who thinks that way and is like, because you could go to somebody and they'll just save you the most amount of money in taxes, but now you're left with no liquidity. You also run into the issue where, hey, you own one commercial building that became worth $10 million. Do you have the skill set to go and buy 3 to 4 different properties and go and manage and run all those just to save money in taxes? Oh, and by the way, now you're retrading at a higher interest rate. You're setting up that new 30-year AM again. So there's just all these things that go in, and it's that push and pull between saving as much money on taxes as possible and like doing what makes the most financial sense.
So what did they decide?
They haven't decided yet.
What do you think they're going to decide? If you could wave a magic wand for them and they would take your ultimate advice,
they're going to probably take my advice. Yeah.
So what are you going to recommend for them?
I recommended to them that of the 10 million, they take about 3.5 to 4 and put it in index funds. You're basically going to just pay the tax on that. And then that way, you know, just with that alone, they're going to be able to cover like basic living expenses for the rest of their life. You can take another 4 to 5 and go and reinvest it into properties. You know, do you pay all cash or do you leverage them? These particular taxpayers are 70 years old. Well,
and that would be a 1031 exchange on that portion of it. Is that what it would be?
They can 1031.
Okay.
If they want.
Okay.
But these people are 30 years old. I'm sorry, 70 years old. Do they want another 30-year AM? Or if they're going to do commercial, it's probably 15 or 20-year AM. Well, it's likely that their kids are going to be paying off that loan, right?
Got it.
Like there's all these things that go into it. It's not just how do I pay the least amount of money in taxes? That's normally not the go-to that I pull out immediately.
Well, that's the starting point of the conversation, but it's much deeper than that. There's other facts and circumstances that have to go into that decision.
Yeah, there's a lot of responsibility that comes with deploying that much money at a time in real estate. I remember a couple years back when I was still doing sales calls, I had a guy call in and he's like, I want to buy $4 million worth of real estate. I said, oh, you're going to buy $4 million purchase price? He's like, no, I got $4 million cash and I'm aiming to buy about 10 to 12 worth of real estate. I said, have you ever owned a rental property before? No. Okay. Do you have any hospitality experience? No. I'm a tech employee, right?
I see where this is going.
I'm like, do you understand how much risk you're taking that you have no control over? I'm talking market risk of properties going down in value. I'm talking interest rate risk. There's massive operator risk involved there, especially if that person's not going to hire out managers or co-hosts or property managers. There's so many things that are literally just out of that person's control. And I'm like, man, my best recommendation for you is take $1 million of that, go invest it in the first year. After a year, wait and see if you still like it or not. Then go to deploy another $1 million, another $1 million, another $1 million to follow. But don't just go and spend $4 million just to save it on taxes when you don't know what you're doing.
You've become known as one of the leading voices around short-term rental tax strategies. What first attracted you to that niche?
Yeah, out of college, I was reading the Brandon Turner books and the Bigger Pockets books, and it was like, hey, you can buy these long-term rentals. I started house hacking. I house hacked my first 2 or 3 properties, lived in one side, rented out the other. And I'm like, okay, this is great. Like I'm cash flowing pretty well, but I'm going to need like 50 of these things in order to, make 20 grand a month. And then I found short-term rentals, and I stumbled across like these people renting out their properties, and the same property that I was renting out where I was getting $1,100 a month. I threw it up on Airbnb and I made $3,000 the second month after renting it out. And I'm like, oh man, I can probably get to my financial freedom goals quicker by doing this. This was probably early 2020. And then at the same time, I had just passed the CPA exam, and I was still studying that real estate tax, code. And that's where I noticed the whole thing called the short-term rental loophole, which allows highly compensated W-2 employees to invest in short-term rentals and be able to offset their W-2 income without having to be a real estate professional. And I'm like, well, shit, I could do this too. And I can also teach other people how to do it. And the first year that I discovered the short-term rental loophole, I bought the down payment that I put on the property was equal to the tax savings that I got. And so it's almost like the government funded my first purchase, my first short-term rental. And I'm like, damn, this is crazy. And that was at the time where interest rates were super low. So, and people, lenders were giving out 10% down secondary home loans like candy. So somebody would go put 10% down on a $500,000 property. They'd save $60,000 or $70,000 in taxes by doing that. And so it was almost like they got their down payment funded by the government in that first year. And so I'm like, man, I got to tell everybody about this. This is like the best thing since sliced bread. This is like the 8th wonder of the world, And
is it still good?
It's still good, minus, the interest rate environment that we're in, as well as I would say, the competition, right? So I don't know the exact math on this, but I would bet if you look at the amount of cabins that are available in the Smoky Mountains per se in 2026 compared to that of 2020, I wouldn't be surprised it's 3 to 4 times higher in terms of supply, right? And so then you go into economics where the supply, if supply outweighs the demand, then what does supply have to do? Lower prices. It's like my history professor said, if everybody's a millionaire, no one's a millionaire. So then you also sort of see this competition in markets where, hey, if you don't have a pool inside your house, well, 2 or 3 guys down the street do. where's the guest going to go book? Probably the house with a pool, considering all else equal. If you don't have a hot tub in your place, where's, which one's the guest going to book? And so that's probably the downside to it nowadays, is the interest rate environment that we're in, as well as just the competition that we're seeing.
So if I have an investor or client that is a high W-2 income person, they've got a 6-figure tax liability, let's say it's $100,000 on their W-2 income, how do they use short-term rental loophole to eliminate or significantly reduce that $100,000 liability?
Yeah, so it starts with understanding exactly how tax benefits work in real estate. So we start with that tax liability. Okay, they're going to owe $100,000 in taxes. Well, we needed to know first, how much depreciation do they need in order to offset a $100,000 tax bill? Because it's not $100,000 in depreciation that they need. It's the depreciation multiplied by their tax rate, which gets them the tax savings. So if they're in a 30% tax bracket, they're going to need about $250,000 to $300,000 in depreciation in order to wipe that $100K bill away. Well, how do you get $300K in depreciation? You likely got to buy something worth $1 million, $900 to $1 million, right? So then, okay, now we know here's the targeted purchase price. Here's the range it needs to be. But what are the other things that we have to look out for? A big one is, and I was probably one of the first people to ever talk about this because I noticed it. One of the big things is where you buy the property. So land can't be depreciated. So if you buy properties in areas where the land's super high, like any beach in Florida, California, anything that borders the water, New York City, like anything that the land is worth a lot of money, you're not going to get as much tax benefits, right? And so I started teaching investors, where you buy and what you buy is actually really important. Because you go and spend $1 million in California where the land's 80% of the purchase price, you only got $200,000 building, right? You go and spend $1 million in the Smokies where the land's only worth 5%. Well, now you got a lot of tax benefits there. I had a client who did that similar thing, bought $1 million property in Smokies, saved like $150,000 in taxes. Then she went and bought $1 million property in Gulf Shores the next year, only saved $45,000. Why? The land is worth 70% in Gulf Shores. Condos and townhomes can be your friend because most of the time you don't own the land that the condo or townhome sits on. So if you're going to be investing in those high land areas, look into condos and townhomes. I know they don't appreciate as much and you have to deal with shitty HOAs and bylaws, but they're better from a tax perspective because you don't own the land.
Do you also help provide the investment analysis as well? So there's a saying that keeps coming back around in all of the tax strategy and tax planning conversations is you can't let the tax tail wag the investment dog, right? And so do you help your clients analyze, yes, you can get a tax deduction and it'll offset, your tax liability to a certain extent, but this is either a good investment or bad investment?
Yeah, we're not able to technically give investment advice as to, I think this property is going to be a good cash flowing property. I do have a lot of templates that I've personally used that I've given to our clients and email followers as to how to actually analyze a property. So I personally teach a 3-metric rule where it's based on math, where if you can check all the 3 boxes, then it's impossible for you to buy a property that's not going to perform well. I teach a gross revenue test. Number 1 is the purchase price to gross revenue has to be bare minimum 15%. So if I'm buying a $500,000 property, my revenue needs to be $75K bare minimum, right? The second test that I teach is what's called operating expense ratio test. That's basically every single expense for the property except your principal and your interest. So it includes taxes and insurance. You got to keep your operating expenses between 35 and 40%, okay, of the revenue, right? So if I'm doing 75K in revenue, I need to keep my expenses between 22,000. What would that be? 22,000 to like $26,000. And then the last test that I teach is called the debt service test, where my monthly principal and interest payment can't be no more than 35 to 40% of the revenue. If I can check all those boxes off, well, then I know that I can cash flow between 15 to 20%, meaning every dollar that I bring in revenue, I'm keeping 15 to 20 cents of it as profit.
Be really cool if you could provide us a link to that. We can put it in the description section of the YouTube description, and where it links back to your website where these people could get access to you after they fill that out. But that'd be a great value add to provide for the listeners if that's something that you're able to do. It'd be really cool if you could do that. Another thing. Go ahead.
The goal with that is we all, Bill and I teach investors too, is first and foremost, the property's got a cash flow. And even before that, you have to know what you're getting yourself into. So to us, it's like the property's got a cash flow. There has to be appreciation upside there. And the tax benefits are just a cherry on top.
Yes.
We've seen people make really bad investment decisions buying solely based on tax benefits.
Yes.
Here's the deal. It's like we had somebody come to our workshop one time. I want to say this was end of 2023. And she was like, Ryan and Bill, I wish I would have met you guys a year ago because you probably would have prevented me from making a bad mistake. And I was like, well, what's going on? She's like, well, I bought this property and at the time I had feelings that it wasn't going to work out. But I was like staring down the barrel of a $70,000 tax bill. And I just wanted to buy this property so I didn't have to pay the tax bill. And she's like, that property since the last 14 months has lost me like $3,200 a month. So then I was doing the math in my head, and it's like she goes to buy that property to save 70 grand. She's losing $3,000 a month. 2 years later, more than that. 2 years later, she's in the same economic benefit because she saved 70 in the first year. Now she's down 70 in 2 years, and she's stuck with a loser. She's stuck with a losing horse, right? And so we've just seen people make really bad mistakes just to save money on taxes,
Yeah, so that's why you can't let the tax tail wag the investment dog. That's a great analogy. Unfortunate story, but a very true story. Another thing I found fascinating was hearing you discuss successfully defending an STR audit. And most people panic when they hear the word audit from the IRS. What actually happens in that scenario?
So the first thing they do is they send you a letter to your house. They will not call you. They won't text you. They will not email you. So any correspondence through that measure, it's a scam or it's somebody else. All they do is they send you a letter to your house. They tell you that your tax return is under examination. At that point, you have the ability to either represent yourself or you can hire a CPA, an EA, a tax lawyer. You probably wouldn't use a tax lawyer at that point, but you can hire a CPA or an EA to represent you. In the first interview that you have with an IRS agent, whether it's over Microsoft Teams, that's what they like to use, or it's in person, that first interview is kind of like they ask you these basic questions. They ask you, actually, if you ask me, very personal questions like where did you go to school at? What's your primary residence payment? How many bank accounts do you have? How many kids do you have? Are you still married? Like these personal questions. I asked an auditor one time, I'm like, why do you guys ask where they go to school? Like, what is that? Why do you guys ask that question? She goes, well, we're trying to figure out how likely people are to fall for tax scams. So we asked them what their education level is, right? And I was like, oh, I find that pretty interesting. And I guess they correlate, the higher the degree of education, the less likely somebody is to fall for a TikTok influencer scam, right? So you give them that information, and then a lot of times, especially with short-term rental loophole audits, it comes down to, did you meet the qualifications? Where did you have your average of 7 days stay, which is you pretty much add up the total amount of days that you rented out the property and you divide it by the number of bookings that you had. And that needs to be 7.0 or less. So if I had 150 days rented on Airbnb and I have 50 different bookings, 150 divided by 50 is 3. Well, how do you verify that? Airbnb, VRBO make it really easy to print out the summary of all your bookings for the year. It'll tell you the guest's name. It'll tell you when they checked in. It'll tell you when they checked out. And then you'll also see the receipts and invoices for things like that. That one's really easy to verify. The harder thing to verify is the taxpayer has to manage the property to a certain extent throughout the year. So they can't really have a property manager. A lot of times they can't have somebody running the property for them. The taxpayer or the client has to be the one, setting up the furniture, getting the Airbnb booking link live, communicating with the guests, communicating with the cleaners. You can have cleaners, that's totally fine. You just can't be completely hands off for the short-term rental loophole to work. So they,
Active
you send them the Airbnb.
Is that what that is?
It's called material participation.
Material participation. Got it.
Yeah. Basically, you and your spouse, if you're married, have to spend more time than anybody else in the property, whether that's a cleaner, a handyman, a contractor. And you have to keep a time log to prove it. So in fact, we're so diligent with our record keeping and our time logs. We require the time log. If you want to write off a short-term rental loophole to offset your W-2, we require the time log from you. We have templates, we have examples, we have videos. I've done dozens of hours of content around this. But if you want to write that off, we got to have a log. The logs, obviously to safeguard myself, but also to safeguard you in the event that you get audited. But we're 8 for 8 in short-term rental loophole audits because I think a lot of it is a pat on the back to the education that I do in the space, but also the diligence that my team does when it comes to actual tax filing. There's been some people who have asked us to help them defend their audit. And I'm like, okay, here's exactly what I'm going to need from you. Do you have this or not? They're like, no. I'm like, I'm not going to defend you because the last thing I want to do is promise that I'm going to get you out of jail and, send you a $5,000 bill for my time and you not win,
Yeah.
We've had that happen before.
Well, let's talk entrepreneurship. Let's talk entrepreneurship real quick. You've grown quickly. You've built multiple firms. You've built an audience. You've built a brand. What have been the biggest lessons scaling a professional services business? The
biggest thing for me has been, and this is not just professional services. This could also be HVAC, handyman, contractor businesses. Basically, any business that you have a founder, and then the founder is wearing all these hats in the beginning, is growing a team, building a team, hiring, firing, delegating tasks. To get the tribal knowledge out of your head as quick as possible. So there's a lot of stuff that the business owner knows that his team doesn't know or her team doesn't know. There's a lot of how-tos that he or she knows that the team doesn't know. And whether you have 1 employee, 10 employees, or 50 employees, you got to get that tribal knowledge out of your head if you ever want the business to run for you without you involved. And so when I mean tribal knowledge, I mean literally breaking down every single step of the process in your organization and creating SOPs for them. SOPs are basically anytime I see something where I have to do it more than twice, I create an SOP for it. And then I'm able to, assign that to somebody and teach somebody how to do that. If you want to scale an organization, you need to have really good SOPs. You can't just let your team kind of run with things or create their own stuff internally. That's not going to work. I remember right about when I was at my second year of doing this full time, I had a staff of about 6 or 7 people. And I remember I took an entire week or so of my time to teach this process of how we're going to reach out to clients in the beginning of the year in order to get all their information that we need in order to file their tax returns. So I'm talking getting them to sign the engagement letter, getting them to sign invoice or pay invoices, getting them to do all this stuff, right? And I taught it all on Zoom. Me and one other person. And her responsibility was to go teach everybody else. So we doubled in size within 6 months. We went from 7 people to 15 people in 6 months. And then 6 months later, I'm sitting there watching the other employees do the same task. And I'm like, wait a minute, this is not the way that I taught you guys how to do this or taught her how to do this. They'll find these little easier shortcuts or they'll find these ways to do stuff. And I'm like, why is this happening? Well, it took me so long to realize they need to follow the damn SOP. And in order for them to follow it, I need to freaking create it. So like everything you do as a business owner, if you want it to be the last time that you have to do that, you need to create a good SOP. What is a good SOP? Number one, it has the title of it at the top. Number two, it has a purpose. The purpose of this is to accomplish this goal. Here's the step-by-step. Number one, log into here. Number two, log into this. Number three, do this. Number four, number five. And at the end, you film a Loom video going over every single step by step. So like there's no confusion, right? Each SOP is linked to a task in your organization, and that task needs to have a defined due date. If you don't give somebody a due date, it's not that it'll never get done, but it'll keep getting pushed off. Every task needs to have one task assignee, one person, and it needs to have a due date, right? So if I'm going through like a tax preparation process, it's like somebody's assigned to reach out to the client and get all their documents. Okay, once they're done with that, now somebody's assigned to like go through that and organize that. Okay, once they check that complete, now somebody's assigned to go and prepare that tax return. Now that that's complete, now somebody's assigned to go, and it just happens automatically. There doesn't need to be like so many hands in the cookie jar, right? And so that would probably be my biggest piece of advice if you're looking to scale is get the SOPs out of your head, get the tribal knowledge out of your head as quick as possible. We have what we call a client success playbook, which is an Excel document with about 60 different tasks in our organization. They're sorted by position. So if I'm hiring a new tax preparer tomorrow, she can go in and see the 7 or 8 different tasks that she'll be assigned to, and she can go and review those and see, okay, this is what I'm responsible for. Here's how I do it, like just to get their feet wet. A lot of business owners, if you're sub 10 or sub 15 employees, for you to hire a new person means that you have to take away time from doing what you do best, which is not like hiring and training people maybe, which could be marketing and selling or something else. But for like the first 15 or 20 employees for me, that meant like I had to take time out of my day to go and train these people, get them access to logins, get them access to emails. It's like now we have an SOP. Whenever we onboard somebody, those tasks are assigned to somebody on our team to make sure that they get logins. So then I don't have to spend my time doing that. So.
And it's not just SOPs. No, super helpful. I hope it's helpful to the listeners. I think it should be. It's SOPs and KPIs, right?
Yeah.
I mean, those are the ways to set your business up to be truly founder free and pass the hit by a bus test, right? So if Ryan Bakke got hit by a bus today, those SOPs, assuming you have the right people in the right seats on the bus, those SOPs are going to be the thing that helps keep the business not just surviving, but thriving through that period when you're not there.
It'd be like if I was a bus driver, and I had a heart attack while driving the bus. There needs to be somebody that also knows how to drive a bus, but then there needs to be somebody that can like rally everybody, keep them all calm. There needs to be somebody that's like dialing 911. Right.
Yeah. Yeah. Because if you think about it, right, let's say you're going to make your business, and this is true for all the listeners as well. But if you want your business to be attractive for someone to purchase it, or for you to put it on the market for for you to sell it.
Yeah.
It's not sexy if everything has to go through Ryan, right? For your business to work. But if Ryan's built a business where it works without him, in spite of him, and not only does it just work, but it thrives and continues to grow at a certain clip, that's a successful business that some investor might look at buying into, or some company might look at making a strategic acquisition, or if it's got good cash flow, that's where a financial purchaser might come in, right? Because I might not know the first thing about being, doing STR tax returns and working with those types of businesses. But if I can buy your firm and it continues to function with you not being there, that's an attractive business model. And business owners, unfortunately, don't often set it up that way, right? Because everything runs through them. And it's just due to, lack of putting those SOPs and those KPIs in place, like you've talked about. Little transition though. So on one topic we discuss constantly on the Uncommon Wealth podcast is the topic of liquidity. And business owners, entrepreneurs often become asset rich because of their business enterprise value, but cash poor. Have you seen this happen in the clients that you deal with?
Only every day of the week, even Sunday. Yeah, it's just you have even people who are primarily W-2 employees that are investing in real estate, more so for business owners. And I always say this, I say equity always grows quicker than cash flow. So you take a rental property, for example. There's clients who have rental properties that generate them $20,000 a year in cash flow off of a $700,000 purchase price. Well, that $700,000 property is going to appreciate $21,000 to $30,000 a year, which is more than the cash flow that it generates. So when you look at it, it's like it grows like this. Like the cash flow goes up over time because you're paying down interest and you're becoming a better operator. But that equity is going to grow exponentially, right? It's even more so for business owners. So, if I'm a business owner, my business is going to trade at a 3x multiple. And I increase cash flow by 50 grand. Well, I just boosted the value of the business. I say 50 grand, or I made, 50 grand profit, but I just boosted the value of the business by 150 grand. Right. And so people have to keep in mind their balance sheet and their liquidity, because it is not like out of the ordinary for us to see people who have 90% of their net worth in hard assets that are not liquid, that they can't physically touch. I would say real estate is probably more liquid than that of a business in terms of the timetable to sell a business.
Yeah, I would agree with that.
A lot greater. But even so, it's like, well, if you want to pull money out of property, if you're doing a refinance, the timing's got to be right. The interest rate market's got to be right. If you're looking to sell a property, same thing. Like every 1% that interest rate goes up or down, another 4 million people can or can't afford to buy a home. So that's something to consider too on the liquidity table. You have a client or somebody who's got a portfolio of properties that's going to be their retirement fund, or they're going to sell all of the properties when they retire. Well, the interest rate that they get at that retirement, age is very important. If I have a portfolio of properties that is worth $10 million, or let's just say $1 million, and right now the current interest rate market's 5%. Well, if that interest rate goes up to 7 by the time I go to sell all those properties, I'm looking at going down to probably $800,000 in sale price, because every 1% the interest rate goes up or down, it normally swings purchase price by 6 to 8%, depending on market. All very important things to consider. And you definitely see this a lot in professional service firms, where before they'll go and sell the entire company, they'll start selling off parts or interests of their business to partners and allow people to buy in so that they can really de-risk themselves. So if you're an owner of a business and you have some really key leaders in your company and you plan on selling in the next 5 to 10 years, well, that's a big proponent of what you're going to get it for is, what are people paying for businesses in 5 to 10 years? Who knows? But you can de-risk yourself a little bit by giving, allowing key players to buy in to your business. And that's sort of a way to kind of take cards off the table.
Have you heard of a strategy called a first lien HELOC?
Yes. Sort of. Explain.
Well, I just got introduced to it. I've heard of a second lien HELOC. Like when I use the word HELOC, home equity line of credit, and it's typically in a second position after the mortgage, right? Mm-hmm. But a first lien HELOC, and I didn't know they existed until a couple weeks ago, is exactly what it sounds like. It is a first lien HELOC issued by a bank or a credit union that is a simple interest calculation, just like a traditional second lien HELOC would be, but it can be up to 70 to 80% of the value of your property. Now, what I don't know if it exists on investment properties or vacation homes or rentals or things like that, but that could be an interesting play if a first lien HELOC was available in the real estate investing world to create that liquidity when needed, because when you have a HELOC, right, you can draw on the HELOC whenever you want. You don't have to go through the approval process all over again. You just draw it down and then you pay it back over time. I just didn't know if you'd heard of it or if it exists in the real estate investment world.
It's probably the first lien HELOC probably has to be through the same bank that has the original loan on it.
Well, it would pay off the original loan.
Oh,
so that's the thing. That's the thing. The issuing bank of the first lien HELOC is paying off the mortgage, right? And so let's say you have a home that's worth $1 million valuation, and in that $1 million valuation, you can get 80% of the value in a HELOC of $800,000. If you have a mortgage outstanding of less than that, it would completely pay off the mortgage, and now you just have that differential available in the HELOC. But the strategy is then to use excess cash flow, because it's a simple interest calculation that's recasted daily instead of an amortized interest calculation over a 15 or 30-year note. You're making those payments into it to pay down that outstanding loan balance, so you have more liquidity available in the HELOC.
Yeah, there's got to be some restrictions around that, because in that example, it's like, let's say there's a $300,000 loan out there by the original bank, and I'm the first lien HELOC guy. I got to go pay that loan off, right? Mm-hmm. Cash them out. In order for me to make money, you actually have to use the HELOC and pay me interest, no?
Yeah.
So there's probably some, that's I don't know, side note to this. You know what I'm saying though? Like, there has to be some sort of hoop there, because it's like, okay, I'm the first lien HELOC guy. I'm going to pay off that $300,000 loan. I'm only going to make money if you actually draw on the thing. So there's probably
that $300,000 is part of the HELOC. You've drawn on that HELOC of $300,000 to pay off the mortgage. So they're accruing. You're moving it from one lender to the next, but you're moving it from an amortized loan schedule to a simple interest HELOC schedule, right? And it's the same $300,000 debt. The question is, as you make payments on it, are you paying it down more interest, or are you paying it down more principal? And I don't want to derail the podcast conversation from that. I was just curious if you thought about it, because I was thinking about that from that liquidity standpoint, because I deal with the same issue when I deal with premium finance life insurance clients. Is they are on their balance sheet and net worth statement, they're wealthy. The question is, where's the liquidity on the balance sheet, right? Mm-hmm. So just a question. Couple more things to go through. Looking ahead, where do you think tax policy is headed as a country? Do you think, let me rephrase it more specifically, do you think that they're going to abolish the Internal Revenue Code, the IRS?
No, that I know for sure. Yeah. As to why, I mean, the tax code, if you ask me, it probably is the thing that's propping up like half the real estate market. So you have all these people that have these properties that are sitting on like 1031 deferrals or cost seg benefits or 1031s, et cetera. And so if they abolish the income code, all these people have no reason to like keep their money in the properties anymore, and they can just sell them, which would cause a huge crash if everybody's trying to sell at the same time. Same thing with 401k accounts. So probably half of the equities markets, if not more, is pent up on 401ks and IRAs, like tax deferred accounts. People have to leave that money in there until they're 59 and a half, or they have to pay a penalty. Well, if tax code goes away, people are going to sell, like they have no reason to leave it in retirement accounts anymore. They're going to sell. The stock market would go down 50% in one day if they abolish the code. Dead serious. And then last thing, probably like charities, Make-A-Wish, all these like charities and foundations. Like, yes, people are giving people, for the most part, but, Red Cross, all these, like they would take a massive hit if there wasn't any reason to, you know what I mean? So that's why I don't think that they would abolish it. Yeah.
Bro, I've been saying this for years. Why do you think some of the wealthiest families in the world are the most philanthropic families in the world. And I get a lot of pushback when I say this. Yes, they want to do good by doing good for other people, but it's also for the tax benefits, right? The tax benefits of making charitable donations and charitable contributions is one of the main reasons charitable giving is what it is, right? If you, to your point, if you abolish that incentivization in the tax code and genuinely people have to give because they're good people, those charities and foundations are going to see a lot less giving coming in on an annual basis.
Mm-hmm. Yeah. And that's why I don't think that they would abolish it. Plus, how much money the government's in debt by. So,
another area we spend a lot of time on this podcast talking about is helping entrepreneurs solve liquidity, estate tax, succession planning issues, and creating tax efficient wealth transfer strategies. And Ryan, I'm curious, when you're working with your highly successful investors and business owners, what are some of the biggest planning gaps you see after the tax strategy has been optimized?
Mm-hmm. First thing is always to invest in what you know and understand. So if you don't know and understand it, or you can't hire somebody that can teach you so you can know and understand it, probably not a good idea to do it. You want to know and understand it. The other thing I would say, it comes with, I have this new rule that I call the 60% confidence rule, where you cannot wait until you're 100% sure that something's like a real estate deal is going to work, or you can buy this property, because for you to be 100% confident, things are going to go under contract right away. Anyway, Elon Musk, when he founded SpaceX, you think he was 100% confident that he could compete against NASA? Tesla, you think he was 100% confident that he could compete against the gas powered car? Probably not. The guy who bought his put all his life savings in Bitcoin in 2012, for him to be 100% confident that he would have paid CPAs, financial advisors, a lot of money, and then they would have told him, no, that's a really stupid idea. So I have this new rule that I call a 60% confidence rule, where if I'm 60% confident that something's going to work, I try to take action. So taking action quicker when you have access to new information. I think another thing that's one of the bigger things that's missed is many people are not prepared for a tragic event. So we come up with this idea that we call the financial preparedness document. I just did a presentation on this in Chicago a couple weeks ago. But you have a Google Drive or a link or a document that has, well, where's the trust at? Okay, here's the link to that. Where's the trust lawyer that did it? Here's their contact information. Who's the realtor for all these properties? Who's the lender for all the the loans on the banks? Who's in charge of financial POA, medical POA? A lot of people don't know this. When your kid turns 18, you cannot legally make a medical decision on their behalf if they're incapacitated or they can't make a decision for themselves, because they're seduced. Medical POA solves that, right? Just things like that. Basically having everything, if you have a parent or a loved one or you're older and you have kids, you got to have a Google Drive that has links to, where's the bank accounts at? Where's the IRAs at? On those IRAs or 401ks, do they have beneficiaries listed? Are they the correct beneficiaries? We've seen clients marry and remarry and have their old spouse on the IRA or 401k account because they forget to switch it over, right? Well, have fun in probate about that, right? Just having a financial preparedness document, I think most people are missing. That should be like a Google Drive. It should be on a floppy disk. It should be, printed out, put it into a safe. Can
you get us a copy of that financial preparedness document?
Yeah. One of the things that I'm seeing a lot recently is there's still a lot of what I would consider savvy, smart investors, people who built a lot of wealth over the years that don't understand the difference between traditional and Roth and the pain that can come with it. You're in your retirement years, you're not earning active income. start making Roth conversions, start paying some tax on that money, because I promise the tax rate on your beneficiaries, it'll be later down the road, and it'll be a greater amount of money that you're paying taxes on, because time value of money and the stock market says your money is going to double every 8 to 10 years. So not only is the amount of money that you're paying tax on going to go higher, but also that tax rate in the future, I personally think is going to be higher. Couple that with, I've never seen our clients, and maybe it's survivorship bias, because, we work with upper income people, people making $300,000, $250,000, $300,000 a year or more, mostly. I've never seen somebody inherit an IRA or a 401k and not pay the top tax bracket on it.
Right.
Why? Well, mom or dad passes away, 70, middle 70s, early 70s. The beneficiary is normally in their highest earning years. They're between 35 to 45, maybe 50 years old, and they're in their highest earning years. Well, their W-2, it's filling up that bucket. They're already at a 32, 35% on their W-2. Now they have to pay 35% tax on that IRA. And so just planning around, okay, I have these low income years in retirement. I got to start doing Roth conversions now. So that way that money never gets taxed again, either for me or my beneficiaries.
I love that. And, and with the new law changes, that now they cannot stretch that out over their lifetime anymore. They have to distribute that inside of 10 years. And so that really exacerbates that tax liability that you've talked about. Well, Ryan, this has been outstanding. I'm 60% confident this was a good podcast.
Good.
No, I'm actually 100% confident this is a good podcast. For everyone listening, where can they learn about you, Tax Strategy 365, your content, and your work?
Yeah, you can find me on all social media platforms at Ryan Bakke CPA. So that's Instagram, TikTok, Twitter, Facebook also. If you're interested in the templates and the resources, they're inside of my school community. So that's skool.com, not like school, regular school, but this is tax school. So it's school, skool.com/taxes. We have all the templates in there. There's 20 templates in there. I do like live community calls. It's $1 to get in. Arguably, like literally the best financial
value
could ever make.
Best value for $1 you can get at this point. And we're going to have links to all of his stuff in the description section as well. And we're going to also put a link to that school academy in the description section as well. So Ryan Bakke, thanks for your time. Thanks for joining on Commonwealth Podcast.
You're very welcome. Thank you.
Thank you, buddy.